The stock market talks to me, and I mean that figuratively, not literally. Contrary to what you may have read on X, formerly known as Twitter, I do not hear voices, although periodically I think that my left molar crown does indeed play music. But that's not what we're talking about here. I'm constantly listening to the tape, not music, to get a read on what the big institutional money managers are up to. And to do that, I need to separate the signal from the noise. What do I mean by that? Okay, on any given day, there might be monster moves in individual stocks. It's tempting to assume that all these swings are equally significant, but some are a lot more meaningful than others. So when you see the cloud stocks for just getting killed, for example, the natural conclusion to draw is something must be wrong with the cloud. When a really loathed group bounces, it's not much of a stretch to assume that the pain must be over.
The house of pain.
But that's too easy. The truth is, some of these moves are a signal, and some of them are noise. Signal means something. It tells you that the stock will probably keep moving in the same direction. Noise, on the other hand, well, it is noise. To borrow my favorite line from Macbeth, noise is a poor player that struts and frets his hour upon the stage, and then is heard no more. It is a tale told by an idiot full of sound and fury, signifying nothing. In short, while signal carries a message, there's no real takeaway from noise. In another life, Shakespeare would have been a dynamite investor. Distinguishing the signal from the noise is as much an art as a science. So how do you tell when a major stock swing heralds something larger? Before we get into what makes a move meaningful, you need to understand that we get major single-day advances and declines with no real significance all the time. Good stocks can get ahead of themselves, rallying too far, too fast before selling off. The technical term for this is overbought, and chartists measure it with the slow stochastic oscillator, or the Williams percentage R oscillator, named after the legendary Larry Williams we talk about a lot when we go off the charts. When something's overbought, it means pretty much everybody who wanted the stock at a given level has already purchased it. Even the highest quality company can have an overbought stock, and when you run out of buyers, you almost always get a pullback. But this kind of overbought sell-off doesn't tell you anything, except that the stock in question needed to take a breather and digest its gains.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.